Hey, how's it going there? Welcome to Jazz After Dark. I got a fun one tonight, actually. So, you know how we do the Flaviar thing and we're working through some Japanese whiskey there. I got a gift from James S., I'll just say, and it's Maker's Mark. He goes, "Hey, bud." A little note that was with it. He said, "Hey, bud, you're getting awfully fancy there. You just, let's just be men for a minute." Oh, uh-oh. Oh, there we go. So he says, just enjoy this. We don't always have to have the fancy stuff. And so I appreciate that, James. We will be enjoying the Maker's Mark here tonight. Tried and true, right? Keep it simple. I got a piece in my mouth. Welcome to Jazz After Dark. Hope you've got yourself something to drink as well. Appreciate the gift, by the way. That was kind of fun to open because, the Flaviar thing, if you do it, we get something for it. We don't get money, but we get something for it. And I think they send us free ones. They've yet to send us a free one. But they, it's oddball stuff. Things that you just, maybe you don't want to buy the whole bottle or whatever, but good old Maker's Mark. I hope you're hanging in there and ready to chat a little bit tonight. This is not going to be one of those for the kids that go, "It took you 60 seconds to tell me that when it should have taken 3. We're going to think a little bit deeper. And I'm going to do this by sharing something that we're sharing with clients. Every now and then clients will say, "Hey, would you mind putting a little something together for me about X, Y, or Z, whatever the topic is?" And I've been getting some questions on the Fed raising rates, how the markets perform around that time period. And, well, you give me a weekend where there's nothing going on because I have no friends and I just start putting things together. So tonight I'm going to share with you kind of what we're talking to clients about. Wouldn't be right, obviously, if I shared everything, but we can go into this for the moment. And I've got some cool data to share that I had some time to put together. So basically, where the market is at right now, and I'm talking about the futures market, they're pricing in that we're basically at the end of the Fed hiking cycle. If you don't know, this has been the steepest of all, and I'll just share this with you here. This is the steepest and fastest rate hike that we've had. What I did is I put from the time that they had their first rate hike to the actual end of rate hikes, and then of course the current cycle, we're assuming this is the end or very close to the end. So you can see that their pace and aggressiveness of raising rates was a lot faster than anything on record. Here's 2015, where they started a series of rate hikes that were very, very far spread out. 2006, the most aggressive, of course, as we went into the chaos of the financial crisis, and the other years in there as well. And so here we stand with the steepest on record there, right? So, take that for what it is. Now, the market, and I've shared this in a couple different places before with you guys, but the market tends to perform well at the end of rate hikes. Doesn't mean we don't go into a recession, right? In fact, there's a lot of scenarios where we eventually do go into a recession, and I've got that data for you as well. But the market averages a 3-month return I've got here of 8%, and I'll show you in a second, 5 of the 6 times it was actually higher. And this goes back to, I believe I went to 1982. We'll come to that in a second there. Now, when we look at the performance of the market going forward, remember the market and the economy are 2 different things. So economy going into a recession is likely, and that has happened in the past. I'll share that with you. But we just don't see that as the base case in this example here. I don't think there's a high probability of us going into a recession. That could change, but for right now, we have unemployment record lows, even though we have a lot of layoffs going on. There's all kinds of stuff out there that suggests we're still spending money and the economy is still technically growing, and even so, not at as slow a rate as you might think. So I wanted to kind of share some of that stuff that we're talking about with clients. And part of the reason that the futures market is suggesting that rate hikes are about over is because of the stress in the banking system there. We've reached a point where rates are so interesting to the average saver that they're no longer willing to keep their money in the bank as much anyways. And so where we stand now is the futures market's pricing a 50% chance of a 25 basis point or quarter point rate hike when we come up to the, it'll be May when they do the next rate announcement there, right? Which at this pace, the year is, going by quickly. And in fact, if you look past May and you want to look this up, you actually will find that the futures market is predicting rate cuts after that. I don't know that that's so likely there, but that's what we have there. So like I shared with you a second ago, one of the things we're pointing out to clients is, hey, this is the fastest rate hike ever in history. You're living it, right? You got the t-shirt, you're living in this. This is all, fine. Average between all of those was about a 2.9% rate hike over the course of that. So again, if I go back over here, I didn't get it on there, but the average is about 2.9%. 300 basis points is 3%, 400 is 4%, etc. So you can see where we stand. Plot the average in there, you get 2.9 is essentially what we're focusing on. Now we have, what has this been? This will be 12 months in here, of course, being the shortest and fastest there, raising rates by almost 5%. We think, and the Fed has made it clear, that there's probably 2 more left, but nonetheless, that is, the market's pricing in 1 more, essentially a 50-50 shot of 1 more, and then maybe holding for a little bit and tossing in 1 last quarter point. Very unlikely that we see a half-point rate hike, even at this point so far away from the Fed meeting. It's just not very likely. So we'll see how that goes, but that's currently, where we stand there. Like I said a minute ago, stocks as a whole, and we'll use the S&P as an example today, they generally do really well. There's one example where they didn't. In fact, that was through the year 2000 during the dot-com bust there. But we've got an average of 8%, but we range in performance anywhere from, if we're looking out a year, anywhere from 14% to 1%. So, and like I said, you got 5 of the 6 that I'm about to share here with you that actually finished higher there. So if we're at the end of a rate hike period or getting close to it, we don't really want to miss out on that, right? Those are, going back to a couple classes ago, that's where we get into missing some of the best days in the market. And we know that once you miss 40 of the best days in the market over a 25-year period, like you get 40 shots, if you miss the 40 best days over a 25-year period, you have a negative annualized return, meaning you'd get to the end of 25 years and you would have lost money after 25 years. So we don't want to, get into that. Dillow Research, and if we look back at previous Fed tightening cycles, we'll call them there, during higher inflation type environments, think the 70s, think the 80s, we are going to have the same conclusion that, markets are going to head higher. That's basically what happened during those times there. There are some exceptions, and let's just get to it. Talk about this here. Sit here all day with you guys. So not that I don't mind, but the S&P performance around the end of rate hikes, what we did, and I took another shot at this. I made the chart the other day, but it wasn't really clear, and tried to make this a little bit more clear. So anything in negative back here to the left of the 0 is leading up to the final rate hike, right? So we don't know for sure that this is in fact the final rate hike or will be, but we can use history to say, well, that was the last rate hike there. Let's measure the market going backwards 6 months and forward 12 months. It is very clear and easy to see that there is just one time period here in 2000 where we hit the end of the internet, is supposedly what people called it, and we fell. But if we look at the other 5 examples, I've also included the average. I tried to make it stand out. Hope you can see it in orange there, in average. Couldn't figure out how to make it the front one for some reason, but I'm not a pro at this stuff. And so here's what we have. Average gains, 14%. So I just mentioned just a second ago. So that's kind of looking through it there. Now, you can take a picture of this and save it if you want, but that's where the market performance ends, and we're using the S&P. Here's where it gets a little geeky. I took all the data and then some, because we had, like I said, I had no friends, nothing to do. I got to get out more. But here's what we've got. Don't let it scare you. Here are the dates on that chart that we just shared there. It was these are each one of those. All right, so now going forward, we can see how long was it until the Fed cut rates, and I put the median in there as well. I really went nuts with this, but tried to simplify it with you guys to not make your eyes gloss over. What I want to point out is there was a next recession. The only time that we could say, there's two actually, the only times that really we wouldn't attribute the recession to the rate hikes were 1995 and 1984. I was 2 years old then, so I can't speak to that other than using the data. However, a recession is very common after rate hikes. This is their goal. They've actually stated this. If we raise rates and we go into a recession, that is better. Well, they're saying that's better than having long periods of high inflation. Seems like we're still getting the inflation though. So they've actually said that. It's not my words. They're like, if we go into a recession, so be it. That's the same wording they've used in years past as well. Now, inflation is measured by CPI, and the Fed likes to use core CPI, so taking out some of the volatile energy components, as we saw yesterday in the oil markets there, right? And so inflation, look at where inflation was at the end of the rate hikes there. We are much higher. This is the highest that we've been. We're currently sitting at 5.5%, just over 5.5%. And if this is in fact the end. And in the past, inflation wasn't so much of a concern relative to how it is now. That 2%, they call it 2% area that they're looking for inflation. Now you know why. This is where it was in the past. This is where they found their equilibrium and why they're shooting for about that 2% range. Of course, in 89 and 84, inflation was an issue and they were trying to bring that down. Ultimately succeeded, although, recession. But so be it. If you look at the news, they say, well, the economy is not growing. You can't have growth at this pace and consider it a healthy economy. That's true. We currently have 0.3% GDP, meaning the growth of the United States, how we're manufacturing things and people buying them and then reselling things, and the general economy there, to simplify. You can't be where we're at now. So this is tricky. The Fed has to slow the economy down, but we don't have much room to fall into what we would consider a recession. Even to go negative, right? And remember, the number doesn't have to be negative to be in a recession. According to the traditional definition, it just has to decline. Well, we don't have much room to decline and then turn negative, meaning we're not going forward, we're going backwards. So that's a consideration there as well. This is why most people say, okay, we're going into a recession. We're already humming along at a really slow pace. We don't have much growth to sacrifice here. One little slowdown and we've officially turned negative there. One thing I want to point out though is the stock market, and this is the reason that I'm hoping for a pullback, the median PE ratio, meaning the price you're paying for the S&P 500 versus what it's supposed to be worth over the next 12 months, NTM's next 12 months. The median is 13 times, meaning for every dollar you put in the market, you are assuming 13 times growth or earnings on that dollar, which will allow you to hopefully make a profit. The stock market will move higher. Didn't we just say there's not a whole lot of growth there? We just kind of noticed that. These are why these columns are together. So you're paying right now 18 times earnings for the next 12 months when we're not seeing a whole lot of growth. So this right here tells you if you buy the market right here, you are overpaying relative to history just by a little bit. If you take the 10-year average, you're about 17, so it's not much. But look at it compared to history. You were getting a discount already in 84, a discount already in 89, a discount in 95. A little overpriced in 2000, but we saw what happened in 2000. That was the year the market pulled back. He did not get a pullback in 06. He did not get a pullback in 2015 when the market was what they would say fundamentally inexpensive or trading cheap. That's how they would, they would say the market is cheap here. Well, why do they say that? If the market's actually up, why would they say it's cheap? They're focused on earnings relative to either the next 12 months or where we currently stand. Now, here's the earnings growth projection. This is not my data. I'm not guessing. I wouldn't do that to you. Growth projections were rather high in the past. So coming out of this rate hike scenario, we had already assumed that there would be good growth in the overall companies that make up the S&P. We don't have that this case either. This is all of the analysts basically were putting together their average. And what this is suggesting is people recognize, analysts realize the market is a little pricey, just a little bit. We're not expecting a lot of growth, and we have, at the moment, not a lot of growth to play with. I don't know how else to say that. So if you think about it for a second, well, no wonder we're putting money in CDs and money market accounts, because the market, well, think about, the big boys, right? The people that study this stuff. No wonder they're saying, let's use money market funds, let's use bonds, let's use something else, because for the moment, we can justify that. That's a return that beats the expectations and current environment of the stock market. That's partially why, and I've said this numerous times, I'm telling clients that are worried about this and they want to get in the market and hurry up before they miss anything, that's why the market won't rocket ship back up to highs. Number one, there's not a lot of money compared to the times before. In years past, we had no availability to invest anywhere else. You couldn't go to money markets. They were paying 0.1%. So you had to put your money in the stock market. That's why you have those rocket ship rallies. Now imagine the tens and now hundreds of billions of dollars that have gone over to the bond market. They're not interested in stocks right now. They realize they're slightly expensive and there's not a lot of room for growth, or at least projected growth. So people are over here. That's one of the reasons that you see what's going on in the banking system going on. It's not fear. It's not people believing their bank is going to zero. Maybe a little bit, but that's what it is. Anyways, forward returns still are optimistic. So looking through, I wanted to break down, I didn't make a chart. You could easily make a chart of this, but 3 months after the last rate hike, 9%. That's not for the year. That's not annualized. Median return in the 3 months is 9%. 6 months, 12 months, 19%. Okay, that's kind of interesting. So what I'm trying to present to you, and what I was trying to present to clients as well, is bottom line is a recession is likely at some point, but not likely due to the rate hike in the Fed. You could disagree with that, but for the moment, my data wins. So it's what it is. If I'm wrong, we have a recession. What do we know happens during recessions? Stock markets bounce, right? Remember, very first thing I said, don't confuse the market with the economy. The economy can be very weak, but as an economy gets weak, all of a sudden, what happens to earnings? We say, well, we don't expect you to earn so much. Our expectations are lower. We realize, people aren't going to Target as much. We expect them to make less. And so when they start making a little bit more than expected, bam, there's the bottom in the market there. I've shared that data with you numerous times about that as well. So we have a base case, and I hate that I say that because that's so CNBC, but the base case is that the market is not heading into a recession. And I firmly believe that, meaning not because of the rate hikes here. I hope that people look at the stock market and continue to say, I'll go over here to bonds. You know how people chase what's exciting. So people that have no business being in bonds, I hope they continue to do that because it relieves the volume pressure. Just like we saw yesterday, the volume was really low in the market. That was odd. So it relieves the volume in the market, which means it's harder to move that sucker up. And one little bout of panic or, profit taking or whatever causes the market to go down. And people go, well, I'm not going to pay for that. It's still overpriced, overvalued. I'm sorry. I realize earnings and growth and projected earnings and growth are just not there. So therefore, the market should be worth less. That's what I hope happens. And whatever happens in the economy, if it wants to slow down, that's fine at some point, and it will. But for the moment, that's where we stand. So what does that mean? Sum it all up real quick. It means that pullbacks in the stock market are almost buyable, right? Not like if it falls 1% or something, but we realize that it's almost cheap to buy the market, not currently. But pullbacks to a degree are buyable. And I mean a healthy more than just like, we had a bad day, right? Pullbacks are buyable. A recession is, probably inevitable at some point, but for the moment, we have the Fed sitting there going, we have room. We just raised rates all this much. If the economy slows down a little bit faster than we're hoping, we cut the rates again. People go refinance, start buying things again. We're human, right? That's how we do it. So we've got that going on. And when you look, did I have it for you? Yeah, here we go. If you look individually, sector performance after the end of rate hikes, what does well? The very sectors that move the market. The tech sector has a good day, the stock market has a good day. The darn thing makes up, it used to make up almost 30% of the entire stock market. Now it's more like 24 to 27 depending on the week. Over here, communication services. They have a big say in the stock market. A little bit less now because they just did a big change on the 17th, but nonetheless, this is the performance 1 year after the end of a rate hike. Communication services, the best performer, outperforms itself even. Financials outperform itself over a 1 year period, even a little bit less as you go down. The tech sector easily outperforms itself. Materials outperform itself. The ones that are underlined is how I know to say that. That's my sneaky trick for you. A little behind the scenes, huh? And so we now have a reason to believe that even sector pullbacks, financials, I'm not sure that they've settled down yet. There still seems to be a lot of people running around like chickens with their heads cut off. But at some point as that settles, you go, wait a minute, this makes sense. Now they're fundamentally cheap. We know we have less volume. We know we have the end of Fed rate hikes. And if we want the stock market to go higher, the financials have to go along for the ride. You almost can't have a rally in the market without financials because they're not as big as they used to be, but they're, second place, third place, I believe. And so now you can start a game plan for what are you going to do? It gives you some insight into what I'm going to do, right, with all of our clients' money. Remember, it's my job. This is why I don't do anything else. It's my job to make the accounts grow. It's the only way we make more money. We're really unique in that sense as financial advisors. We don't sell a product. We go, hey, if your account grows, we'll be right there with you. If it doesn't grow, you might leave us, right? I realize I have to add that value every day. So me studying this with Eric and the entire team, me going over this and helping prepare this kind of stuff, it's a little bit of show and tell. I hope it hits a point and you may end up working with us or something, but it's also to build that confidence that I don't do anything else. Like right now, it's 12:37 at night when I'm making this video. This is what I live for. And if I can give you a little advantage and you see this and this kind of plays out and you start to see some of this stuff happening, you go, man, that guy was right, man. That's the guy I want on my team. So at the end of the day, we don't make money making YouTube videos, although they do pay us some money. It's good, keeps the lights on, but this is what I do this for. I live for this stuff, man. This is why I want to be a part of this every day. And you're literally going to have to claw me out of this chair. But in the meantime, I thank you for the Maker's Mark. I will enjoy this. And I'm going to go try to trick my wife and tell her it is. She likes to taste this too. So I'm going to go tell her it's one of these Japanese whiskeys and see if she picks up on it. I know it's rude. Yeah, but we'll see what she says. I thank you for watching and putting up with a little longer educational class here today. I hope you enjoyed the visuals. I hope it's got you thinking about what the possibilities are instead of just narrowly focusing on doom and gloom or excitement if you're excited about it. Now you know about where we stand. Enjoy. Thank you for watching. Adios.